Okay, welcome to Stock Talk with Nico Criticos. Today we're going to be going through 15 companies, 15 stocks that I think are going to be going down in 2022. And I'm going to explain my reasoning for all this, and we'll go through everything. So first up is Build-A-Bear. This is a company that its most recent quarter, they had great earnings. And so in the past year, the stock's up over 470%, going from $4 a share to $22 a share. And this is one that I think is those type of earnings are not going to be sustainable. So this one deserves to come down a little bit. It needs to take a breather. It's had too big of a run. So next up, we got Portillo stock, and this is a company that fantastic restaurant, great food, but the valuation's too high. And I made a video a couple months ago about why I think Portillo's is overvalued and where I think the share price is going. So you can watch that if you want to see it all broken down. But the bottom line is this company was trading at over a $3 billion valuation, and they only have 67 locations. So even now it's come down a little bit. I still think it's overvalued. So that's pick number one. Next up, we have Lucid. This is an EV maker, and this one normally trades at right around this $18 to $20 mark. But in this past month or two, we've seen more hype around the EV space because of Tesla being so successful. And so I think a lot of these other EV stocks are being pushed up, even though they haven't really proven themselves yet. So Lucid, I think, is a great example of that. Even though I love the way their cars look, I think they do have a great chance at being successful. It's just it's not worth the valuation. So this is another one I see coming down. Next up, we have Rivian, pretty similar. It's another EV maker. This one's even worse because this one has 0 cars produced and their valuation was at $140 billion. So this is another, right now it's at right around $100 billion, but this one definitely is going to come down too. It's just, it doesn't mean they're not good companies. It just means their valuation has to make sense based off of what they have proven. So for a company that hasn't had any car sales, there's no reason it should be trading at over $100 billion. Now, next up, we have a company I love. I love this company. I love the business model. It's just, once again, valuation's way too high. So this Intuit is up 90% on the year, okay, going from $375 a share to $675. This is another one it needs to take a breather. It's just a lot of these big tech stocks, a lot of the big market cap stocks have had money pushed in there from the hedge funds and the retail investors. I think a lot of people were aiming for safer stocks, during this whole pandemic time. And so that's why companies like this got pushed up so much. So next up, we have NVIDIA. This is the company I bought into this past summer, and it went up 50% and I sold it. Like right around here, I bought it down here, went up 50% and I sold. And it ended up going up a whole lot more. It's up another, 50, 60% since I bought it. But NVIDIA, it's one of the greatest companies on the planet, probably, but the valuation's way too high. This one needs to come down a little bit. It's a little bit too overvalued. Next up, we have Adobe. Pretty similar story. This is a great software company, great business model. It's just valuation's way too high. This is a large cap stock, so a lot of money went in there. Next up, we have Microsoft. This is especially one that people were really putting their money into this, up 54% on the year, a little bit too overvalued. And then this one's a little bit different. Cleveland Cliffs, this is a steel producing company, and it's up 71% on the year. Now, this one really benefited from a lot of the inflation and a lot of the increases in material prices. And I think that's going to come down a little bit in 2022, and a lot of those benefits are going to go away. Next up, we have probably the best example, and that's Apple. And Apple's the world's largest company. They have great demand and stuff, great business model. It's just the valuation's too high. It's going to come down a little bit. This one's up 34% on the year. So, and we'll look into in a little bit. I'm going to take you through where these hedge funds are putting their money and where these valuations are compared to other stocks in the market. So then next up, we have Google. Google's another one. It's had a fantastic year. It's up almost 60% on the year now. Next up, we have Deere. This is another great company, but just look at these past 5 years. This company normally trades at $150 a share. Now it's $350. All right, next up, Home Depot. This is another large cap stock. And this one also benefited from people working on their homes in the past year or two for the pandemic. This one's up 49% on the year, and it's another stock that needs to come down. This one's different. This is Bath and Body Works, not a large cap company, but it's up 140% on the year. So this is another one that needs to take a little bit of a breather. Then we have Pfizer. And I understand Pfizer is doing good now because of the vaccines and stuff, but it's just this should be more of a stable company, and this huge volatility is going to come down next year. And so I think Pfizer is going to come back down to this $40 mark. So we'll see what happens there. Finally, we have Build-A-Bear. This is also not a large cap or a safe stock like the other ones, but this one just had an enormous run this year and is up 480% on the year. So now let's get into my reasoning for all this. So if we look at a lot of those companies I pointed out, like Apple, Google, Microsoft, those are the companies that make up the majority of the NASDAQ and the indexes. And here are the top positions in the NASDAQ. You can see Apple, Microsoft, Amazon, Facebook, Google, Tesla. So these are the companies that, for the most part, have had a great year and have pushed the indexes up so much. Now, if we look at this, we can see this is for the forward PE ratios for S&P 500s divided by large cap, mid cap, and small cap stocks. And as you can see, large caps have not reached these levels since 2001. So normally large caps trade at about maybe a 14 or a 15 forward PE. And so they're just way too overvalued right now. Mid caps are somewhere in the middle, not too bad, not too good. Small caps are trading insanely cheap. As you can see, right now, the small caps are trading at a 14.5 forward PE. Normally, they trade at around a 17. So that's what makes me think the small caps are very undervalued. Now, if we read this article, there's some conflicting stuff in here. This sentence says, if inflation rises along with improving economic growth, it will be a favorable environment for small cap stocks, right? Because small caps are better insulated from global developments. Next paragraph says, small caps perform much better on average in months when inflation declines, with the S&P small cap index gaining 1.4% on months with decelerating inflation and 0.5% on months with accelerating inflation. So that's kind of confusing, doesn't really add up there. This chart shows you over the past couple of years, where do small cap stocks trade based off of forward PE ratios. And as you can see here, it's the forward PE ratios of small caps relative to the S&P 500 index. So they normally are trading right around, the average is 1.45, okay? You can see in March of 2020, they touched down to 1.2, but for the most part, it's around 1.3 to 1.5. Well, right now we're at a 1.22. So we're trading an 11% discount from where small caps trade at in the last 5 years. Then if we move on here, we can see this is what hedge funds are buying. This is the listing for Apple stock. The blue line is the stock price. The red line is the amount of hedge funds. 2019, there was a little under 3,000 hedge funds holding Apple. In 2021, there was 3,700. So a lot of money went into Apple right there. Then we have this is one of the biggest hedge funds in the world, if not the biggest, BlackRock. And you can see the number one position is Apple. As of the past couple of months, they actually started selling some shares. So that's a sign that this is already happening. But Microsoft, Amazon, Google, Facebook, all have been increasing. Next one, if we look at Vanguard, we can see very similar things. They actually increased their position in Apple. Same thing with Microsoft, all these big tech. And so these make up a big percentage of their portfolios as well as the indexes. And just based off of all this information, you can see where the money is flowing into big tech stocks. And the small cap stocks have suffered a lot this year, partly because of mostly because of inflation, I want to say, but also because of interest rates. And so once the whole inflation thing kind of eases next year, along with the supply chain disruption, I think we're going to see a lot of benefit go to small cap stocks, and the large cap stocks are probably going to just chill out a little bit, not decline a whole lot, but just definitely come down to more stable levels. And a lot of that money is going to flow into small cap stocks. So that's my view on the market for the next year. Let me know what you think. Comment down below.